Forget Wall Street high fives and stock ticker celebrations. The 2008 financial crisis was more like a runaway fire truck barreling down Main Street. The flames of this economic meltdown didn't stop at the US border. They roared across the Atlantic, engulfing Europe in a continent-wide inferno. This wasn't just a case of a few risky investments gone bad. It was a perfect storm of complex financial instruments, misplaced trust, and a domino effect of collapsing institutions that sent shockwaves through the global financial system. So, grab your fire extinguisher and join us as we delve into the story of how a subprime mortgage meltdown in the US sparked a full-blown economic crisis in Europe. A perfect storm of risk. In the years leading up to 2008, European banks became entangled in a dangerous game. Lured by high returns, they eagerly invested in complex financial instruments called collateralized debt obligations, CDOs. These CDOs were essentially bundles of loans, including a significant portion of subprime mortgages from the US housing market. These subprime mortgages were inherently risky, as they were issued to borrowers with poor credit histories who were more likely to default. European banks, however, assumed the housing market boom in the US would continue, making these risky loans a sure bet. This assumption proved disastrous. When the US housing bubble burst, American homeowners began defaulting on their mortgages in droves. As these defaults rippled through the financial system, the value of the CDOs plummeted. European banks, suddenly holding massive amounts of nearly worthless investments, faced a crisis of confidence. Fearing further losses, they became hesitant to lend to each other, even for seemingly safe transactions. This credit crunch choked off the flow of money that is the lifeblood of any economy. Businesses starved for capital to invest and grow, while consumers struggled to obtain loans for homes, cars, and other essential purchases. The once vibrant European economy began to sputter and stall. Lehman Brothers, the domino that toppled Europe. The collapse of Lehman Brothers in September 2008 wasn't just another domino falling in the global financial crisis. It was a wrecking ball demolishing Europe's already fragile economic stability. European banks, already heavily invested in risky subprime mortgage-backed securities, were facing potential losses. But Lehman's demise sent a tremor of panic through the entire financial system. Imagine a network of interconnected pipes, where banks represent the junctions and money represents the flowing water. European banks, apprehensive about their exposure to the subprime crisis, were already wary of lending freely. Lehman's fall shattered any remaining trust. Banks feared that their counterparts might also be on the verge of collapse, making them hesitant to lend even to seemingly creditworthy institutions. This sudden halt in lending froze the flow of money. It was like all the pipes in the network seized up simultaneously. Businesses, starved for capital to operate and expand, ground to a halt. Consumers, unable to secure loans for homes, cars, and other necessities, tightened their spending. This domino effect plunged Europe into a deep recession as economic activity contracted sharply. The Lehman Brothers collapse wasn't just a single event. It was the tipping point that sent Europe's already strained financial system into a full-blown crisis. Vulnerability of the Eurozone. The Eurozone's economic structure, while intended to spur economic integration and collaboration, acted as a double-edged sword during the 2008 financial crisis. The adoption of the euro in 1999 created a single currency, fostering trade and eliminating exchange rate fluctuations between member states. However, this crucial step towards unity wasn't matched by a unified fiscal policy. Unlike a federation like the United States, the Eurozone lacked a central authority that could bail out struggling countries during economic downturns. This meant that when the crisis hit, weaker economies with high debt levels were left largely on their own. Furthermore, the Eurozone suffered from inconsistencies in regulations across member states. Banking rules and borrowing limitations varied considerably, creating a patchwork approach to financial oversight. This disparity exposed vulnerabilities in weaker economies, where looser regulations often coincided with high national debt and limited ability to raise taxes through domestic means. In such circumstances, countries were particularly susceptible to the financial panic that rippled outwards from the US subprime mortgage crisis. The Eurozone's structural shortcomings hampered its ability to respond effectively to the crisis as a whole. whole, exacerbating the problems faced by its more fragile members and pushing some to the brink of financial collapse. The debt crisis emerges. As the 2008 financial crisis choked off economic activity, a vicious cycle of debt emerged in several European countries, most prominently Greece. The recession led to a dramatic decline in tax revenue as businesses struggled and unemployment soared. At the same time, social spending rose as governments implemented measures to soften the blow for citizens. This widening gap between income and expenditure pushed these nations deeper into debt. To finance their growing deficits, these countries increasingly relied on borrowing from external lenders. However, with their economies in turmoil and creditworthiness deteriorating, investors became wary of lending them money. This triggered a dangerous spiral. As these nations became riskier borrowers, investors demanded even higher interest rates to compensate for the increased risk. The high borrowing costs made it even harder for these countries to repay their existing debts, creating a seemingly inescapable debt trap. The long road to recovery. In the aftermath of the financial crisis, Europe embarked on a long and arduous journey towards recovery. The path was paved with a mix of rescue efforts and tough medicine. Bailout packages were injected into struggling economies to prevent complete financial collapse. These funds, often provided by the European Union and International Monetary Fund, were intended to stabilize banks and governments on the brink. Additionally, bank recapitalizations were implemented. This involved pumping fresh capital into European banks, replenishing their coffers, and restoring confidence in the financial system. However, these rescue efforts came at a cost. Austerity measures designed to reduce government deficits and national debt were enacted across much of Europe. This involved cuts to public spending, tax increases, and wage freezes. While these measures aimed to bring long-term fiscal stability, they also triggered social unrest and hampered economic growth in the short term. The recovery process was slow and uneven. Some countries, like Germany, with strong economies before the crisis, bounced back relatively quickly. However, others, particularly those heavily reliant on borrowing, faced a more protracted struggle. It took years for many European economies to regain their pre-crisis momentum, with some still grappling with the lingering effects of the crisis today. The lingering scars. The 2008 financial crisis wasn't a fleeting storm for Europe. It was a seismic event that fundamentally altered the continent's economic landscape. The crisis exposed the cracks in the foundation of the Eurozone, highlighting the need for a more unified fiscal policy and robust financial regulations. While Europe has patched up the immediate damage and limped towards recovery, the long-term repercussions continue to linger. Income inequality has widened as austerity measures squeezed social programs and disproportionately impacted low-income earners. The crisis also rattled public faith in traditional institutions, fueling political instability and the rise of populist movements across the continent. The scars of the 2008 crisis serve as a stark reminder of the dangers of financial excess and the importance of building a more resilient economic system for the future. The 2008 financial crisis may seem like ancient history, but its impact on Europe continues to be felt today. Understanding this complex economic saga can help us prepare for future financial storms. So, if you found this breakdown informative, be sure to like and share this video. Also, don't forget to hit that subscribe button for more content coming your way.